Welcome to the Deep Dive. Today, our mission is really laser-focused on one of the most, transformative and you could say disruptive intellectual legacies of the 20th century.
We're talking about the work of economist Milton Friedman.
Exactly. And we're not just here to, define his theories. We're going to analyze the systemic consequences of when those theories actually hit the real world.
That's right. We're doing a deep dive into how Friedman's dual vision for the economy. You have monetarism on the macro scale, and then shareholder primacy for corporations.
Right.
How they acted not just as separate ideas, but as a singular systemic force.
A force that, and this is the core claim we're examining, promised market efficiency, but in reality paved the way for an economy really obsessed with extraction.
Extraction over, say, broad-based prosperity. And the result was this widespread erosion of, economic stability, people's livelihoods, and even the dignity of work itself.
So Friedman, a Nobel laureate, the intellectual pillar of the Chicago School, he gave us these two colossal pillars of thought. And when you combine them, they fundamentally change the entire purpose of economic activity.
And before we get into the fallout, we really need to define what those pillars are.
Let's do that. Let's start with the big picture, the macro side, monetarism.
Okay, so monetarism was Friedman's direct challenge to the post-war Keynesian consensus.
The idea that government should actively manage the economy.
Exactly. Keynesians believed the government could and should use fiscal levers, spending and taxation, to stabilize demand. Friedman argued the complete opposite. His core idea was that the supply of money is the main and really the only effective lever of economic life.
And his famous quote about inflation really just hammers that point home, doesn't it?
It's the whole thesis in a nutshell. Inflation, he said, is always and everywhere a monetary phenomenon.
Simple, powerful.
Incredibly powerful. It meant that if prices are rising, it's not because of unions or greedy corporations. It's because the central bank is letting the money supply grow too fast. Full stop.
So the solution is just as simple.
Yeah.
Take the messy, unpredictable hands of politicians off the economic levers.
Precisely. So if that's the doctrine for the macroeconomy, what about for the corporation? The boardroom, the CEO?
That brings us to the second pillar, the Friedman doctrine, or as we mostly call it today, shareholder primacy.
Right, from his huge 1970 New York Times Magazine essay. And that concept is just brutally simple.
The only social responsibility of a business is to increase its profits.
That's it. Full stop.
And it's important to remember, this wasn't just presented as a good business strategy. It was framed as a moral and, you could argue, a legal mandate.
Absolutely. It was a fundamental shift. I mean, for much of the 20th century, the corporation was sort of seen as this social institution that had to balance the interests of workers, suppliers, customers, the whole community.
Friedman redefined all of that.
He did. He said the corporate executive is solely an employee of the owners, the shareholders. Their one and only fiduciary duty is to maximize returns for those owners.
Okay, so let's unpack this, because this is the core of our deep dive today. You have this macroeconomic philosophy, monetarism demanding limited government and maximum market freedom.
And you have a corporate philosophy, shareholder primacy, demanding relentless profit maximization.
So how did these two powerful, seemingly separate ideas merge to create the landscape we see today?
Well, I think the philosophical victory of monetarism, the idea that markets are best left alone, it provided the perfect justification, the perfect intellectual cover for shareholder primacy to pursue maximizing wealth, even if it came at the cost of the old social contract.
Okay, jumping into section one, let's really dig into foundations of this free market philosophy. Friedman's biggest contribution, you could say, was providing this really powerful theoretical reason to limit the state's power.
Which, of course, dovetailed perfectly with the corporate goal of maximizing profit without any, external constraints.
The elegance of his approach was really its almost mathematical purity.
It was. His core belief was that discretionary fiscal policy things like government spending, sudden tax cuts, stimulus packages was inherently damaging.
Why?
Well, he saw it as leading to political distortions, to lobbying, to special interests. It just creates massive uncertainty for businesses.
He basically saw the messy, slow political process as the enemy of an efficient market.
Exactly. He argued that the market naturally finds its own equilibrium, its own full employment, but it's government intervention, especially clumsy political intervention, That knocks it off course.
So his solution was to replace the political with the mechanical.
Right. Replace political fiscal policy with mechanical monetary policy. He advocated for controlling the money supply at a fixed, predictable growth rate, say 3% a year. This became known as the K% rule.
And the idea was this steady, predictable growth would give you a steady expansion and low inflation without any human element.
The government's role in the economy would, in an ideal world, just shrink to this predictable, passive footnote.
And this whole philosophy, this push for rules over discretionary action, it gained massive credibility because of his analysis of, well, the worst economic event in modern history.
The Great Depression, that historical reinterpretation was absolutely foundational to his argument.
Right. In their huge 1963 work, A Monetary History of the United States, he and Anna Schwartz just completely flipped the script on the Great Contraction.
They did. The prevailing Keynesian view was that the Depression happened because of a massive failure of investment demand, a market failure.
Friedman and Schwartz said no, it was a government failure, specifically the Federal Reserve.
And to be clear, they weren't saying the initial crash in 29 was the Fed's fault.
No, but the severity of it was.
Precisely. They showed that the Fed, through just sheer incompetence and inaction, allowed the money supply to contract by a third between 1929 and 1933.
A third. That's a staggering number.
It's catastrophic.
Yeah.
And they argued that this monetary contraction is what caused the bank failures, the sharp deflation, the prolonged misery. The takeaway was just visceral and so compelling.
Government intervention, or its failure to intervene correctly, is what causes economic disasters, not the market itself.
And that gave the whole monetarist school this tremendous persuasive power, this ideological momentum heading right into the 1970s.
And that momentum really peaked when the real world seemed to prove him right with the stagflation of the 70s.
The 1970s were the perfect crucible for his ideas. You had this combination of high inflation and slow growth, which was something Keynesian models really struggled to explain.
And it made Friedman look like a prophet.
It did. And central banks, especially the Fed under Paul Volcker starting in 1979, officially adopted a policy that prioritized controlling the money supply to break the back of inflation. It was a clear victory for monetarism.
But, and this is where it gets nuanced, and it's something our audience will know, monetarism as a policy guide failed almost as fast as it was put into practice. So what broke the model?
This is so critical to understand. The monetarist model, it relies on a stable relationship between the money supply, which they call M, and the velocity of money, V.
The speed at which money changes hands.
Exactly. The famous equation, MVPQ. If V is stable and predictable, then controlling M lets you control prices, P.
But the velocity of money didn't stay stable.
Not at all. It became highly unpredictable, especially in the U.S. after all the financial deregulation in the early 1980s.
Can you give us an example of what changed? What made it so volatile?
Sure. Before deregulation, money was pretty clearly defined. But then you get financial innovations like CDs, certificates of deposit, or NOW accounts.
Interest-bearing checking accounts, basically.
Right. Suddenly, the lines between what counted as money, M1 versus M2, they just blurred completely. Money that used to just sit there earning zero interest was suddenly earning interest, and that changed how quickly people spent it.
So the stable V that Friedman's whole model depended on, it just vanished.
It vanished. It turned into this volatile, chaotic variable, and that made targeting the money supply directly a useless tool for controlling inflation. By 1982, the Fed had already quietly abandoned it.
So the policy failed, but the philosophy behind it survived. It won the war.
Yeah.
Why?
Because that underlying ideological mandate, that markets are self-correcting, that government is the problem, that efficiency is everything, that had already captured the corporate mindset. Monetarism provided the high-level justification, and shareholder primacy gave corporations the practical tools to act on it.
The perfect ideological bridge.
It was.
Okay, so let's walk across that bridge to the second pillar. The moral mandate of shareholder primacy. This wasn't just an economic theory, was it? It was a complete redefinition of corporate morality.
It absolutely was. What Friedman did was provide this morally satisfying justification for pure corporate self-interest.
How so?
He argued that a corporate executive who decides to spend money on something socially responsible, reducing pollution more than the law requires, or keeping a plant open to save local jobs.
That executive is basically being dishonest.
Dishonest, yes. They're usurping a function that belongs to government, which is taxation, or to the individual, which is philanthropy.
And this all ties back to his famous line about spending somebody else's money.
Precisely. If that executive spends on social goals, they're fundamentally spending capital that doesn't belong to them. It belongs to the owners, which means lower shareholder returns.
Or to the customers in higher prices.
Or the employees in lower wages. Friedman's argument was, look, if shareholders want to be socially responsible, they can take their profits and go donate them to whatever cause they like. The executive's job is purely to run the business efficiently within the law.
The only acceptable mandate: maximize returns.
That's it.
Now, this might sound completely normal to us today, but required a huge academic and legal shift to become doctrine, right? This wasn't always the purpose of a corporation.
Not at all. I mean, yes, there was the famous 1919 Dodge v. Ford case that said a corporation exists for shareholder profit. But for decades, that was interpreted pretty broadly. It allowed for long-term vision, for community support, what they called managerial discretion.
So what was the tipping point that made Friedman's view the new orthodoxy?
It was the intellectual rigor that came from scholars like Michael Jensen and William Meckling. Their 1976 paper, Theory of the Firm, was massively influential.
And what did they add?
They introduced what they called the agency problem. They argued that managers, who are the agents, might pursue their own interests, things like perks, job security, building a bigger empire, instead of the interests of the shareholders, the principals.
So shareholder primacy became the solution to this perceived problem.
It became the quantitative economic solution. The goal wasn't just profitability anymore. It became the active maximization of shareholder value.
And what was the mechanism they used to enforce this new mandate?
Executive compensation. It's as simple as that. By linking a CEO's pay directly to the company's stock performance through stock options and grants, corporate boards tried to align the manager's incentives only with the shareholders' desire for a higher stock price.
And that, right there, sets the stage for everything that followed. The shift from productive investment to, well, short-term financial engineering.
Which brings us right to Section 2. So, if monetarism provided the ideological blueprint for market freedom,
then shareholder primacy gave corporate leaders the surgical tools and, I guess, the moral justification to use that freedom inside the company.
And the combined force, it really did act like a wrecking ball on traditional corporate behavior. It shifted the entire focus towards short-term extraction.
The change was profound, and you could see it almost immediately in how capital was allocated. Once the one and only goal is to maximize shareholder value, managers naturally start prioritizing things that give you a short-term share price boost.
Over patient, long-term productive investments.
Exactly. Things like research, employee training, strategic renewal, things that might take years to pay off. The market, now demanding results every quarter, just became this huge distraction.
And I think the most dramatic, the most quantifiable evidence of this shift is the astronomical rise of the stock buyback. Absolutely. Stock buybacks are the single clearest manifestation of shareholder primacy in action. I mean, before 1982, they were basically seen as a form of stock manipulation and were really tightly restricted.
But then SEC Rule 10b-18 came along.
In 1982, yes. It dramatically loosened those restrictions, and the practice just exploded in the decades that followed.
Can you explain the mechanism for our listeners? Why is a buyback so much more extractive than just issuing a dividend?
Sure. So when a company pays a dividend, it's just paying cash to its shareholders. The number of shares stays the same.
Right.
A buyback is different. The company uses its own cash or even borrowed money to buy its own stock on the open market and then basically just retires those shares. They disappear.
So you immediately reduce the number of shares out there.
You do. And even if your total profit stays exactly the same, your earnings per share, the EPS, which is a key metric Wall Street obsesses over, it instantly goes up.
So it's financial engineering. You're using money that could have been used to actually improve the business to instead just inflate a key metric for the stock.
That's precisely what it is. And the scale is just overwhelming. I mean, look at the numbers. S&P 500 companies were projected to spend something like $943 billion on buybacks in 2024.
And heading toward $1 trillion in 2025.
Over $1 trillion. This is an enormous amount of capital being diverted away from productive uses, new plants, innovation, higher wages, and channeled directly to shareholders and, of course, to the executives whose pay is tied to that rising share price.
Okay, but I have to play devil's advocate here. The proponents of this, the Friedmanites, would say that's not extraction at all. They'd say it's the most efficient use of capital.
Explain that argument.
The argument is if a company doesn't have an immediate high-return investment opportunity, it is economically better to return that money to the capital markets.
Yeah.
Right. So investors can reallocate it to some new, more productive venture. How do we square that efficiency argument with the reality we've seen?
Well, that is the core conflict, isn't it? The difference between financial efficiency and actual productive capacity. If those billions were truly being reallocated efficiently to new, innovative companies, you'd expect to see a huge boom in new investment elsewhere.
Well, we don't.
But we don't. When you look at the data on corporate investment as a share of profit, the picture is pretty bleak. In the 1980s, the investment share of corporate profits was, on average, 76.2%.
And by the 2010s?
It had dropped to 66.2%.
Wow. A 10-point drop in the percentage of profit being plowed back into the business. That is staggering.
It's a massive shift, and it implies that managers are focusing resources on, frankly, stock price manipulation rather than building genuine long-term productive capacity. When you prioritize buybacks and dividends, you are necessarily starving the business of the resources it needs to renew itself.
So it's not efficiency. It's a systemic choice for short-term financial returns over long-term economic resilience.
I think that's a fair way to put it.
And this is where it gets really interesting and where the human cost becomes so clear. This shift in how capital is used had a brutal, direct impact on the social contract between companies and their workers.
It did. The mandate of shareholder primacy basically turned labor costs from what was once an investment in human capital into just another expense line item to be minimized.
As low as possible.
As low as possible. If your only goal is maximizing shareholder value and your labor bill is the easiest variable cost to control, then you are ideologically compelled to shed workers and suppress wages.
And the timing here was just perfect for the corporate manager, wasn't it? This doctrine becomes dominant right as union membership is declining and globalization is offering this convenient escape route.
The timing was perfect. The doctrine gave companies the moral and financial justification to move entire industries overseas in search of ever cheaper and less protected workers.
This wasn't just about moving a factory. It was a systemic disempowerment of the entire domestic workforce.
It was. Wages stagnated because workers were suddenly competing with a global labor pool. Their bargaining power, already weakened by the decline of unions, was just nullified by the constant threat of offshoring.
That process sounds like the very definition of extraction. You take the established production, you strip out the domestic labor cost, and you redirect the cash flow that creates straight back to shareholders.
That is precisely what happened. The push for so-called efficiency resulted in production being pushed outside the company's walls or even outside the country, taking the workforce with it.
Which destroyed job quality, traditional career paths.
And led to the catastrophic hollowing out of entire industrial regions. The economy might have been growing on paper, but for millions of people, their real-life economic security and, frankly, their dignity were just steadily eroded. They were bearing the cost of this new corporate ideology.
Moving on to Section 3, the costs of this unconstrained focus on profit, they turned out to be systemic. They weren't just contained within the company or the workforce.
No. They extended into the environment, and eventually they started to destabilize the political system itself. The mechanism here is what economists call the externalization of costs.
Meaning, if the corporation's only responsibility is to profit, then any cost you can push onto society like pollution or community instability is functionally a subsidy for that profit.
Exactly. And you see a direct ecological parallel to the financial extraction we were just talking about through something called the pollution haven hypothesis.
So how does the pollution haven hypothesis work within this shareholder framework?
It suggests that when affluent countries like the U.S. or Western Europe implement strict environmental regulations, which makes pollution expensive.
Companies rationally just move their polluting activities to places with weaker rules.
Right. To jurisdictions where they don't have to pay for it. From the perspective of maximizing shareholder value, it's the only logical thing to do. Externalize the cost of pollution by moving it where it's cheapest.
So the environmental damage doesn't actually go away. It just gets displaced. And this can make the environmental record of developed nations look deceptively clean.
Deceptively clean is the perfect way to put it. It creates a phenomenon known as carbon leakage.
For example, when the U.S. closes a steel plant because of costly emissions standards, and that production moves to a developing nation with laxer standards.
The overall global emissions might even go up, but the U.S. gets to claim a decline in its manufacturing emissions.
And the research backs this up.
It does. It strongly suggests that a huge portion of the supposed decline in U.S. manufacturing emissions didn't come from investing in cleaner tech at home. It came from just moving the dirty production somewhere else, primarily to Asia.
That displacement really brings home this devastating analogy that some critics use, that this relentless search for profit behaves like a malignancy.
It's a powerful analogy because a malignancy tries to grow without limit, right? It invades and devours the healthy tissue of its host.
And in a closed system, which the world is,
The search for unconstrained profit doesn't just stop because it's regulated in California. It just finds new tissue, a poorer country, a desperate community to invade and extract from. The externalization of environmental costs is really the ecological proof of this.
beyond the environment, let's talk about the deep social and political fallout from this feeling of disempowerment and its link to political populism.
The framework of shareholder primacy sends a very clear, very unambiguous message to the vast majority of people who are not major shareholders.
And that message is,
That your job security, your community's health, your wages, they are all secondary objectives. They are expendable in the pursuit of returns for a financial elite. And that visceral feeling of exclusion, of having no voice in the decisions that shape your life, is just deeply corrosive to civic trust.
there's an argument that if people don't experience a sort of democracy at work, where they spend most of their time, their commitment to political democracy itself can start to fade.
That's the critical nexus that many analysts point to when they're studying the rise of populism. When people feel the economic system is rigged, that the profits all flow to the top, and that corporate decisions are dictated by these cold financial mandates.
Then their commitment to a political democracy, which they might see as being equally captured by elite interests, naturally declines.
And that provides very fertile ground for political movements that promise to just overturn the whole system, regardless of whether their promises are feasible.
And as if that lack of corporate accountability weren't enough, we've seen this massive financial shift that further distances corporate decisions from public view, the rise of private financial markets.
This shift is one of the most under-discussed consequences of this whole ideology. When the focus became value extraction, a lot of companies, especially those with long time horizons or a lot of volatility, they just left the public stock market.
It moved into private equity or private credit.
Right, and these private markets were initially regulated very lightly because the assumption was, oh, this only involves sophisticated investors.
But those sophisticated investors now include all of us through our retirement funds. What's the scale of this shift?
The scale is astronomical and it's accelerating. In 2021, for example, new public stock offerings totaled about $435 billion.
Okay.
By contrast, private markets raised $1.73 trillion.
Wow. Almost 4 times as much.
4 times more. So the vast majority of new capital raising and corporate control is now happening in this opaque, minimally regulated environment.
And since pension funds are chasing higher yields by putting more and more of their money into private equity and private credit, the systemic risk is now tied directly to the retirement savings of the very workers who were disempowered by the system in the first place.
Precisely. The IMF and others have flagged this as a growing concern. The system that was designed to maximize wealth for a few is now operating heavily in the shadows, increasing systemic risks through high leverage and a lack of transparency, and it's doing it with everyone's retirement money.
Okay, so this widespread systemic harm, the stagnating wages, the environmental cost, the political instability, it was bound to create a major ideological battle. And Section 4 is all about that pushback.
Right. It's a battle that pits this emerging concept of stakeholderism against a very fierce defense of the traditional Friedmanite pecuniary fiduciary duty.
Let's start with a pushback.
Yeah.
What is stakeholder theory at its core?
At its core, it's the argument that a business doesn't just exist for shareholders. It exists for everyone affected by its decisions: employees, customers, suppliers, and the communities it operates in.
So the purpose of a business is to provide goods and services, not just generate profit.
Exactly. And that requires a kind of social license to operate. It requires stability, not just quarterly returns.
And we've definitely seen a shift in the corporate rhetoric on this, haven't we? Major groups have publicly adopted this kind of language.
The rhetorical shift is undeniable. I mean, you have organizations like the World Economic Forum, the Business Roundtable, which represents hundreds of America's biggest corporations.
All publicly moving away from shareholder primacy, at least on paper.
At least on paper, yes. It reflects this growing consensus that the relentless short-termism demanded by pure shareholder value is actually unhealthy, even for the long-term survival of the companies themselves.
And this ideological shift has a practical arm in the investment world: ESG investing, environmental, social, and governance.
ESG is the policy mechanism designed to actually put stakeholder theory into practice. It's an attempt to push corporations toward more pro-social behavior by using the massive leverage of the capital markets.
For instance, a huge pension fund managing trillions of dollars can use its voting power to hold a company accountable for its climate record or its labor practices.
That's the idea. The aim is to direct capital toward firms that are performing well across these non-financial metrics.
But this ESG movement has generated a ferocious counterpush, particularly from groups defending that strict interpretation of fiduciary duty. They argue ESG is just political activism disguised as an investment strategy.
Which raises this really important question about legal obligation and what it means to manage other people's money.
Right. Groups defending the Friedman doctrine, like the Heritage Foundation, argue that mandating ESG factors politicizes business and is a systematic violation of fiduciary duty.
Their whole critique centers on that specific term, pecuniary fiduciary duty. Can you break down why that definition is so critical in this fight?
The core of the legal argument is that a fiduciary, let's say, the manager of a public pension fund, has a duty to act solely in the financial interests of the beneficiaries.
Meaning their only job is to maximize the risk-adjusted financial return. Nothing else matters.
Nothing else. So if an ESG investment provides a lower risk-adjusted financial return than a non-ESG investment, the fiduciary who chooses the ESG option has, in their view, violated their legal duty no matter how much social good it does.
And the defenders of the doctrine are often very quick to say that any claims that ESG inherently improves returns are dubious or just plain false.
They are. They argue that when fund managers claim ESG factors enhance returns, they're often conflating genuine financial risk, like the risk of a lawsuit over an oil spill, which is a financial issue,
with non-pecuniary social or political goals.
Right. Their argument is if a fund manager really wants to achieve social goals, they need to do it with their own money, not with the retirement savings of public school teachers.
And this gets especially tricky when you think about how many people invest these days through passive index funds.
Exactly. An S&P 500 index fund is required to track the market. The manager can't just sell off shares of big emitters or gun manufacturers without creating what's called tracking error, which is a financial failure.
So their only way to exert influence is through proxy voting, using ESG criteria to vote against management on, say, climate issues.
And the counterargument is that this proxy activism, driven by social concerns, often undermines the financial value of the investment itself, making it an impermissible violation of their duty.
So given that, what are the specific solutions being proposed by those trying to reassert the primacy of a strictly financial fiduciary duty? We're talking about actual legislation here.
The proposals are very detailed, and they're highly focused on tightening legal definitions to remove any ambiguity. A major target is ERISA, the Employee Retirement Income Security Act, which governs private retirement plans.
And what would they change?
Proponents want to amend ERISA to explicitly prohibit fiduciaries from considering any non-pecuniary social or political objectives when they make investment decisions or when they vote their proxies.
And what's the only exception to that rule?
The only way a fiduciary could consider a non-financial goal is if they got explicit, individualized written consent from every single investor.
Which is basically impossible to get on a large scale.
It's designed to be. It's meant to stop fiduciaries from imposing their personal politics on millions of passive investors.
And what about this tactic of creating ties between investments to justify using ESG as a tiebreaker?
They have a proposal for that, too. They argue that in the real world of finance, two investments having exactly the same risk-adjusted return is incredibly rare.
Unless you're kind of fudging the numbers to create that tie on purpose.
Exactly. So the proposed reform to ERISA would require that any claim tie be broken using a random methodology. It's meant to prevent what they call woke fiduciaries from gaming the system to justify an ESG pick.
And finally, this pushback goes beyond just defining duty. It suggests actively penalizing companies that use ESG to exclude certain industries. The economic boycotts idea.
Right. This is often called the Eliminate Economic Boycotts Act, or you see similar bills at the state level. The goal is to stop financial firms from discriminating against politically unpopular industries like fossil fuels, firearms, timber, and so on.
So it creates a commercial downside for any firm that engages in these boycotts.
That's the idea. These laws require companies that contract with the state to certify they don't boycott these industries based on ESG factors. The ultimate goal is to force commerce to remain strictly divorced from social and political goals.
This comprehensive legislative push really shows how central the Friedman doctrine still is. It's not just a theory anymore. It's the legal standard that many powerful groups are fighting to permanently codify and enforce.
It's the ultimate effort to make sure that maximizing risk-adjusted financial return, and nothing else, remains the one unassailable standard for how we allocate capital. It would effectively halt the stakeholder movement in its tracks.
So when we look back at this profound and, very controversial legacy of Milton Friedman, what does it all mean?
We started with his dual vision, right? You had monetarism providing the big macro philosophy of market efficiency and limited government.
And shareholder primacy providing the corporate game plan for maximizing wealth.
And the theoretical structure was, you have to admit, very elegant. It promised stability through rigid monetary rules and efficiency through relentless profit-seeking, all within the rules of the game.
But what happened in practice was that the singular, powerful focus on shareholder wealth maximization, it often just superseded that other part of the goal, open and free competition without deception or fraud.
Right. When the macro policy model of monetarism kind of broke down, its philosophical twin, this doctrine of unfettered market freedom, it just took the reins and accelerated the whole trend toward extraction.
And that acceleration led directly to the systemic harms we've been talking about, the hollowing out of communities through offshoring.
The systemic preference for short-term financial engineering, like buybacks, over long-term productive investment.
And the displacement of environmental costs onto poorer nations. Friedman's theories promised efficiency, but what they delivered when they were implemented in a closed world system with finite resources and finite human stability was systemic harm.
It really did. It forced corporate leaders to see the world through this narrow, unyielding lens of just minimizing cost for the sake of the share price, no matter the social costs involved.
And that resulting damage to the social fabric and the environment led directly to the pushback movements we see today, both the ESG movement demanding accountability and the counter-push fighting to defend the purity of financial duty.
This deep dive has shown us how public policy enabled this entire shift, and how the financial landscape has completely changed as a result. We noted that tectonic shift, where private financial markets, which operate with minimal oversight, are now just dwarfing public markets in raising capital.
That shift is profound. We're talking $1.73 trillion raised privately versus about $435 billion in new public stocks in 2021. And you have to ask, who benefits and who bears the risk in that new world?
We have this growing financial system that is opaque, it's highly leveraged, and it's driven by the exact same imperative for extraction that we've been talking about.
And yet it holds the future retirement security of millions of ordinary workers whose pension funds are now heavily invested in this very sphere.
And that leaves us with a final critical thought for you to explore. How does the ongoing growth of this largely unregulated private finance sector, which often relies on high-risk strategies to maximize returns, challenge the very concept of maximizing long-term stability for the ordinary worker?
When the system designed to supposedly maximize your wealth operates in the shadows and actually increases systemic risk, doesn't that fundamentally contradict the core principle of a fiduciary acting solely in the beneficiary's best interest? That's a question worth exploring as you track your own financial future.
A true deep dive into theory meeting a very complicated reality. Thank you for joining us.